And since we're going to have to just go through a couple of disclosures here, I'm going to go ahead and get those started so we can let everybody come on in. Um, just some formalities here. Securities through Cetera. We're not talking about securities or anything. We're just general discussion. Um, all those views are mine, of course. You can't invest directly into an index. That's how many times have you heard that? More disclosures. Very important stuff. More disclosures. See, it's not really exciting to start off with all these disclosures, but you can always come back and read them. Um, so we're going to just go ahead and get started. It's been kind of a crazy time. A lot of things have happened, some good, some not so good, some very confusing, and we just kind of are in new territory here. So we're going to talk about, at least where we know we've been, and then we'll talk about kind of where we've are and maybe where we're going, which is always the trick, right? So the S&P has just been on a tear overall, but you can see there's definitely been problems. We've had the COVID issues, and then we printed a whole lot of money after that, and then we had sort of massive inflation, and then they started raising rates, and then we had a really pretty bad 2022, and then ever since then it's just been kind of gangbusters up until basically last September. We'll talk about more about that. But as always, for our stock market, the earnings are what drive stock prices. So people still spending money. I think this past Christmas was a big spending, shopping spree for everyone. And of course, all the spending that we're doing at the government level. And people seem to be going out to restaurants and eating a lot and buying mixed drinks. I can see it. So um, lots of spending going on. You can see them everywhere, and that spending is what drives 70% of our economy. So the S&P has definitely been a beneficiary of that. And if you break it down really between what's growth and what's value, and some people think, well, what is value? Does that mean it's a good value? Well, no, it's basically what the stocks do with the earnings that they get. So a growth stock, for instance, will take their earnings and do new research and development, create a new, Apple, I something, and then a value stock will maybe be like a utility or whatever. They're not really doing lots of research and development, but what they do with their earnings is they'll pay them out in dividends to their shareholders. Okay, good. I'm sharing the screen. Mary confirms it. Awesome. So obviously, you can see a lot of the growth here has been part of the artificial intelligence revolution, if you want to call it that. It's just kind of like what happened back in 1998, 1999 with the internet. I mean, I think it's almost exactly like that, except that it's not the internet, it's AI, which is another level of our evolution as humanity. Obviously, 2022 was a super bad year. They lost about 50% during that period of time. And, for most of our clients who are retired, that's just not the ride that we need to be on, especially when you're drawing income. You're in your 40s, you're 35, you're in 20s, you're getting started with your 401k plan. Yeah, go crazy. But when you're taking income out, you have that dollar cost averaging when you're putting money in, but you also have the dollar cost reduction when you're taking money out, meaning that if you have to sell off stocks at a 50% loss, that doesn't feel so good. So if you look at the value stocks, those are the ones that pay dividends. Yeah, they're not as exciting. They don't have those, big jumps like that, but they also don't have those big pullbacks either. So it's usually a good idea to mix those. And if you look at all the different asset classes, so like one asset class would be large cap U.S. growth, one would be large cap U.S. value, and then we have commodities, and then we have small stocks, and we have mid-sized stocks, and then we have international stuff, and then we have emerging market stuff, and then we have international developed, and then we have emerging markets, and then you have Japan, and then you have Asia, and then you have China, and you have to kind of determine, is China an emerging market? Sometimes they stick China in emerging markets, but I've been to China, and I can tell you that there's places of it that are still emerging, but there are places of it that are fully emerged. I mean, it is first class. Shanghai is a first class city, there's no doubt, and probably Xi'an too, and definitely places in Beijing. And believe it or not, Wuhan and Chongqing are also. I mean, there's a lot of cities there that are over 20 million people, and it is. If you've never been to China, I would encourage you to go check it out because it is a life changer. But you only need to go once. You don't need to go ever again. But this is the way asset classes have performed best to worst. over the years. And you can see, just as an example, in 2007, emerging markets were up, like 40%. Then, of course, we remember in 2008, that wasn't such a good year. Everything was down. But look, emerging markets lost 50%, over 50%. So there's a lot of risk there. Of course, in 2009, they were back up 79%. So that's really good for those 30-year-olds. But for our retirees, the balance funds or the balance accounts are generally better. But even in 2022, if you look, the balanced fund or the balanced portfolio, if you will, was down about 14%. So it's not always a surefire thing that you're not going to lose money in a balanced fund. And mostly because during that period of time, interest rates were going up. And so balanced funds had some bonds, and the bonds just absolutely took a bath. And we're going to talk more about that, because when interest rates go up, what will happen to bonds? The price of the bonds will drop. And then, of course, the reverse of that is when the price of or when the interest rates go down, the price of the bonds go up, or they usually go up. They didn't last September. We're going to talk more about that. If we do a little deeper dive into the S&P and then what happened inside the sectors, obviously with the artificial intelligence, communication, and technology, we're the stars again. So it reminds me so much of 1998 and 1999, when the internet was a new thing, and everybody was coming out with new internet stuff, like Webvan. I don't know if you remember Webvan. It was like the first time you could order food from the internet, and I jumped on that van, but Webvan didn't last too long. And we go through these things. It doesn't mean the internet's gone. It just means, MySpace is gone and Webvan is gone, but, Google is still around and Amazon is there, and it's better than ever. So I see the same sort of thing with this AI stuff. I mean, it's really exciting, and everybody's using it, and it's a real big fad right now. But at some point, it's gonna correct, and then stabilize, and they'll be with us forever from here on out. Because you can definitely tell, I can see a lot of emails I'm getting, they're AI written. But again, technology, communications, you can see all the way down here to the right: real estate, healthcare, materials, even energy. All of those have really been lagging. And then if we look at the dividends, who's been paying dividends? Okay, energy. This just goes to show the difference between growth and value. So okay, the growth stocks did really great, but they didn't pay any dividends. Technology down here is not really paying dividends. Communications is not paying much in dividends, but energy and real estate, utilities, those do. So you can see the opposite way that works. Sometimes people or the economy is really in a growth mode, like it is now, and then sometimes it gets shaky, and then people move into dividend paying stocks. And I believe that is kind of where we are headed. I believe, and I know I've been saying this for a while, but I believe that the growth has had a lot of growth. And I think that what we probably need to be looking at now is what's next. And then I think the dividend paying stocks are going to be what's next after we've had a pretty good shakeout. So we can kind of tell where we are with inflation when we look at gold and silver. We know that silver is now pushing $30 an ounce. Gold is about $2,600 an ounce, right around there, up or down a little bit every day. And so those have been a good investment for us, and we'll kind of stick with those. Generally, what happens when we have a big stock market crash or a correction, the Fed will come in and say we need stimulus, and as soon as they talk about stimulus, the precious metals usually spike, and that's when we're going to be probably looking at cutting some of that. Volatility has been pretty low, considering obviously that we had the big COVID-19 spike when we all thought we were going to lose, a fifth of the world's population. That was a scary time. But luckily, we got past that, and now we're, 2022, you can see the volatility. When the volatility goes up, that usually the market goes down. And in 2023, 2024, the market was up for the most part, except for a couple of cases. One was the unwinding of that trade in Japan. You may remember the Nikkei was down. It had its worst one day ever. And that was because of interest rates going up in Japan, and then the difference between the yen and the dollar movement. And so a lot of that was unwinding at that time. And we were down about 1,000 points, but Japan had its worst one day ever. So, things like that are still out there. They kind of come out of left field. You don't really expect them. They're not front page news the day before, right? It just happens that, hey, here's this thing that happened, and nobody was really watching that. But those are the carry trades. And when we have a change in interest rates, one place or the other place or both, and we have a change in currencies, where the yen went up against the dollar at that time, it can cause a lot of volatility. Now, if we kind of zoom out and we look at the globe, the rest of the world, and how they did last year, at least the last couple of years since, our bad 2022, we're just beating the tail out of everybody. I mean, the United States is just tearing it up, and I guess that's because we are developing the AI and all the other things that we have. And I don't know how much you travel to Europe or other countries, but Europeans are just so, I don't want to say slow, but they're just so um, locked into the traditions. They just can't get their idea around something new. It's real difficult for them, and no one is really very entrepreneurial over there. Everyone seems to be wanting permission to do something, whereas over here in the U.S., the idea is, hey, I'm going to take this and run with it. I love the American spirit, and everywhere else in the world I go, I see that America really has something special, and that is our spirit, our entrepreneurial spirit is just unbelievable. And this is something that really kind of took me by surprise, even when I was putting this together. Let's just talk about how great America is. I know there's a lot of problems. I know we got a lot of problems, but in terms of our economy, if we look at the total global market capitalization of all the stocks on the planet, at least in the free world, we don't talk about North Korea, but of all the stocks and all the capitalization on the planet, folks, we're talking about $77 trillion, right? The United States makes up two-thirds of that. Two-thirds. That is incredible. That's just unbelievable. I'm really taking. I knew we were a powerhouse, but wow. If you go back, to like before 2010, we were roughly 60%. We're all the way down now to 67%. So that's just incredible. I mean, pat everybody on the back, right? You guys included. So let's now look at some of the fundamental changes that have happened and kind of where we can expect things to go. Obviously, if we look at the valuations, the U.S. has been on such a tear that our valuations, our stock valuations are very rich compared especially to developed and emerging markets where they're only looking at 12 times earnings. Price earnings ratios is definitely one of the things that we look at. But an even more telling sign is what we call the Shiller PE ratio or the CAPE, which is cyclically adjusted price earnings ratios. Now, the CAPE has been probably the most useful uh, indicator that we've ever been able to use. And I want to point this out because this starts back in 1920. So if we go back to 1920, you can see these peaks. We are now at peak number 3 um, since 1920. So basically the last 100 years. And if you can see what the first peak here was in 1920, basically 1920, 28, 28, 27, 28, 29, right? What happened then? Well, I think you know. And then the last time this happened was 1999, right before 2000. And then what happened then? I think you know. And then we had some right then here, but then basically we're back up to where we were really since 2000. And we're higher than we were even at than the Great Depression. So, I cannot predict the future. I certainly can't predict the timing, but I can tell you where we've been and where we are. And I think you're intelligent enough to make that you make that conclusion. So it's just a time to be very cautious. I know I've been keep saying that, but the numbers don't change. And if you look here, here's one more reason that we've been cautious. Here is not every single, but the 5 main ways that people determine or investors determine the fair price of a stock. And this is definitely one that Warren Buffett looks at. But these boxes in here are the averages, and we'll call that the mean. And then we have these deviations. So one deviation above the mean, two deviations above the mean, and then deviations below the mean. Well, the means here are different things. So one is price to earnings. We've already talked about that. How long does it take for the earnings of this company to pay for itself, to pay for a stock of itself? And anything above 10 or above 20 is a little richer than anything below 10 or below 20. So anything above below 10 is usually a pretty good sign. And on the average, it's around 17, let's say. But here you can see that no matter how we cut it, whether we're talking about the price of the stock to the earnings of the company, the price of the stock to the book value of the company, okay? Because the company has here's what my value should be. Jamie Dimon came out the other day and said that, look, the book value of JP Morgan is this, the share price is this. Okay, you guys need to be aware that our share price is trading a lot above where our book price is. And those things have a tendency to come back into the mean, the norm. It just hasn't happened yet. Okay, if we look at sales, the price of the stock according to the sales, if we look at cash flow to the price of the stock, and if we look at dividend yield based on averages, all of these things here, the red dots are where we were a year ago, which were all above one deviation, but now we're now above two deviations in almost every category, 2.2, 2.2, 2.6 in the price to book. So that's a real thing. That's the real thing, and it's amazing to me that there are people out there investing in stocks just frivolously without even considering any of this information. But that's what happens. If we look at the debt of corporations, it doesn't make any sense really. I mean, interest rates have gone up. Corporations have more debt than they've ever had, and the reason for that is because it was so cheap. I mean, we were at zero interest rates for so long that these companies could just, rack up on this debt and then do something else with it. Hopefully, maybe they were doing stock buybacks, but I doubt it. So the stock prices have soared, but the debt has also soared, and interest rates are up. They did drop interest rates, but we're going to talk about that in well, we'll talk about it right now because it's important, and that is the most significant economic development that we have is the drop in interest rates that happened last year. But you can see how this goes. So we had a recession here coming out of the dot-com bust. And then they dropped rates down all the way to 2, 1%, basically 1%. We had inflation. They started raising rates. You can see a quarter point hikes pretty much every time they met. Then they plateaued, and then 2008 happened. And then we had another recession, and then they dropped interest rates all the way back down again. And then we had a long period of interest rates, almost 7 years here, before the market got back to where we were. So we basically had a 7 year sort of stagflation with interest rates down around zero, close to that. And then before COVID happened, they were starting to raise rates. And that's when we started getting conservative because we've seen this movie before. And then, of course, out of left field, here comes COVID. And that just kind of everything collapsed. You remember that. And we didn't know how many people were going to die. They were saying, a fifth of the population. I remember someone saying over 1 billion people. And that's, it was very scary. So no one knew what was going to happen, how that was going to end. But luckily, it turned out to be, even though it was horrible, it turned out to be better than that. But we printed so much money during that time to cover, everybody's PPP and everybody's stay home and we'll send you a check. So we basically created $7 trillion just from nothing. And we've created money before, but that money never really went out into the economy in the form of checks like the PPP that it did. Because we got PPP and we spent the money. We paid our employees with it. So they took the money and spent it to do what they always do, eat and all those things, So where we are now is we've been raising rates, and we plateaued there for a while because the ground was shaky, especially during 2022. And then all of a sudden in September 18th, September 19th of whatever last year, for whatever reason, the Fed decided to drop it by a half a point, which just kind of surprised everyone. If you go back in time and you look at all the times that they've dropped rates by a half a point, it's always been during sort of an emergency race to the bottom to bail out the economy or to bail out COVID or to bail out 9/11 or whatever it is. So for them to drop, right out of the gate to drop a half a point sent strange messages, I think. And so if you zoom in on it here, you can see really what happened, but no one really knows why they did that. So drastically like that. They'll stair step these 50 basis points up because we were having massive inflation, and that was the reasoning. But to drop it 50 basis points like that, I don't know, sent strange messages, and the market didn't like it, the bond market especially. So what we're looking at here is the corporate value, the corporate index, the total return of all the corporate bonds out there. So here we have the interest rates. Interest rates went up, they plateaued, and then there's our drop of interest rates. They went down a whole point. So we went down 50 basis points, then did a quarter point tick, and then another quarter point drop. And then if you look at the value of bonds, which should have gone up, in every other instance, they go up. For whatever reason, bonds went down. And if you look at it here a little closer in on the treasuries, so here it's a little inverse. So when you look at the yield, we're looking at, here's the Fed funds rate, here's the drop, and then here we're showing the yield going up. So the yield on the treasuries should have gone down, which means the price of the treasuries would have gone up. That's what should have happened, and it didn't. You can see right here it crossed over. And it's not like this was the day after. It's not like this was the day before. This would happen exactly when those guys dropped rates by 50 basis points. Bonds took a hit. And nobody really knows why. The theory is now that, and this is from Barron's, okay, I didn't come up with this, but the theory is that, well, the Fed dropped rates too soon to get inflation under control, and the bond market is telling us that the Fed is going to have to raise rates again. And if you look at times this has happened, again, we're looking at the blue line or yields. So when the blue line goes up, that means the price of the bonds went down. So if you look at it, we zero in to right where we are here, the interest rates go down, the yield went up, which means the price of the bond went down. And that just is not supposed to happen, because just like we saw in 2022, when interest rates were going up, the prices of the bonds collapse. I mean, you can just see there's the bond yields going up right there as the rates are going up. And so when rates are coming down, bond prices should be going up and yields should be coming down. Now, that's happened a couple of times in the past. It happened in 1996 for a brief period of time, and it happened in like 1998, 1999 for a brief period of time. But they reversed pretty sharply and pretty quickly. So I don't see this I don't see this going on for very long. And I think if we have some issues in the stock market, which everything else is saying that we will, this should be reversed pretty handedly. But I want to just point this out because it is an anomaly. And when the bond market talks, you better listen because it's rarely wrong. And what it's telling us now is, hey, Fed, you better not drop those rates anymore because you don't have inflation under control. And you can really see this in the mortgage rates because, again, Fed dropped rates. What should have happened to mortgage rates? Mortgage rates should have gone down. But look what happened. They went up. That's what happened. And again, why? Well, some people say, well, our government our deficit is too high, our debt is too high. There's a lot of reasonings, but you can see that absolutely when they dropped rates a half a point, the bond market just wasn't having it. So we'll see how that turns out. Consumer price index, which is really inflation, more or less a fake number at this point. The way we used to calculate it back in the 80s was more honest. And if we looked at that, we were closer to 8%, 7 or 8%. But according to, the numbers and the formula that we're using these days, which, it's changed 2 or 3 times. So you have to always keep that in mind. We're down around, 3% again, which, the Fed was saying, well, we really need to be at 2. But remember, this is 3% year over year change. So that's 3% more expensive than it was last year, which was like, 10% more expensive than the year before, which was like 8% more expensive than the year before. So this isn't prices getting cheaper. This is just that they're getting expensive, not as fast. All right. It's not great news. So that's another problem. Another thing that looks inflationary is unemployment rate. So unemployment has dropped, and it's always about, well, what do you mean by unemployment? What if someone is working 2 jobs, but neither job has a 401k plan and neither job provides health care? Or what if they're just working, 1 job and then another job is like an Uber or something like that? Or what if they can't work the full 40 hours, or they're at working, several 3 or 4 jobs, and they have a side gig, but nothing is really what we would consider, a job. So, and then you have a lot of people that are just temporary, doing these temporary things. And the biggest temporary employer in the world is the IRS, right? So they're hiring everybody right now that they can to do these tax returns or whatever they do. And then after that, they're just going to lay them off. So again, we look at the leading economic indicators. I know I just feel like I beat this horse to death. I keep dragging that poor carcass back in and beating it again. But in every single instance where we have had negative leading indicators, we have ended up with a recession. So just take it for what it's worth. Here we are again, and leading indicators are those things like building permits. If you're going to put a shopping center in, the first thing you got to do, you got to send out surveyors out there. You got to do building permits. You got to get zoning. So all those things are leading in economic indicators. Consumer sentiment. That's just like how people feel. Well, that's like the most lagging indicator that there is. That just tells you how people feel. Well, if the economy's been great and they've made a lot of money this year, they feel great. If it's been bad, they don't feel so good. So they don't look a lot at that, but leading indicators definitely give us an idea of what's coming down. And then the one thing that you never hear about on TV is, or the news, is the real estate, especially the commercial real estate. But if you look around and you keep your eyes open, and of course I'm in the working world, I'm in and out of buildings all the time here in Atlanta. So I see that they're at least 50% unoccupied. Our building is probably 30% occupied at best. I would say, we went to the King and Queen building over here not too long ago to the CFP group, the Georgia Society of CFPs, and I'm sorry, CPAs. And we looked and it was probably about 30-40% occupied. I mean, every building around here and the other ones down here over by Villa Cristina, I know those are completely unoccupied. And there's a couple of 16, 17, 20 foot floor buildings there. So this really just hasn't hit front page news, and I think a lot of it's because those leases are still in place, and the landlords are doing everything they can to keep this from collapsing. I know ours are. In fact, they're going to change our building to assisted living, so we're going to have to move probably not too far, just right down the road, but. There's not enough office space occupancy here to justify the ownership, so they're going to turn it into assisted living. So you guys may be back here later on before you never know. Consumer sentiment, I just mentioned it is kind of a lag. It's the most lagging indicator. How do you feel right now? Well, not everybody's feeling that great. I guess expectations aren't as great. So what does that mean? Well, they may spend less. They may not take that trip. They may put it off. They may not fly to Spain. They just may go to Disney. Who knows? Um, and then the other thing that's been concerning me really is personal savings. So, when we had COVID, everybody was getting the PPP. Nobody was going out and eating lunch or dinner anywhere. So everybody sort of was saving money, which strangely enough was a good thing. But since then, obviously, our savings rate has dropped way, way back down to now we're down about 4%. So that's our historical average is 6%, and we're down about 4. So that's not a great sign. And again, with inflation, I see people at the grocery store, calculating the numbers, and it just kind of breaks your heart when you see that the calculations are, over a baby formula. So the global central banks, all of them have been, well, except for the Bank of Japan, which they tried to, right? Remember, but they had a big upset. So basically, these are the balance sheets, and the big one, of course, is the Fed, because we created about $7 trillion worth of new money, and then since COVID-19, and then so that money is now sort of rolling off the sheet. So the way that works is the Treasury creates treasuries, and the Fed creates money, and then they just swap it, and then eventually that Treasury expires, and when it expires, that just kind of unwinds, and then the money that was created out of nothing just vanishes. And that's how it works, folks. That's our fiat currency, the way it works. It's been working that way since 1917. I got to tell you, we could do a lot better, but nobody listens to me on that front. Anyway, so if we look at all the central banks, they've all been reducing their balance sheets, and they've all been pretty much lockstep with their interest rate hikes and their interest rate, drops. So they've all been hiking, and they've all plateaued, and now they're all dropping. So the problem is the bond market, whether it's here or really internationally, the bond market, internationally even, and especially the U.S. Treasury market, is saying, you don't have inflation under control, and those rates should go back up. So let's look at quickly who owns all this debt. Our U.S. debt is through the roof, and it continues to go up. And you can see the blue here is really the U.S. debt that's owned by us, U.S. consumers and investors and citizens and banks and insurance companies, lots and lots of insurance companies. So, and then of course there's 7.4 trillion that's held by, it says government, but that's really the Fed. So this is the Fed's money, which is just completely and utterly made up from nothing. This is money that was paid for by people like you and me that had money, that worked for the money, that paid taxes on the money, that are investing the money, that are still paying taxes on the money. Um, so, this, I call this honest money. I call this dishonest money. And I don't know how you feel about that. But, everyone asks me, what about this election? And how Trump's going to do this, Trump's going to do that. And yeah, I hear all that. But an economy is like an aircraft carrier. Okay, I don't know if you've ever been on a really big cruise ship and somebody saw somebody in the water, or they saw a raft or something, and they have to, maritime law says you got to go check it out. So you might be on your way from the Canary Islands down to Aruba, and you got to turn around and go look to see if there's somebody out in this raft. Well, it takes a long time. It takes a long time to turn that ship around. It takes a long time to get up next to where the raft is, and it takes a long time to get back on your track. I mean, it takes like 3 hours. It's amazing. Well, the economy is a lot like that. It takes a long time to change things around. And so a lot of times one president will get credit for what the last president did, and then one president will get, trashed for what the last president did. So it's just impossible to say, okay, this party or that president did this or that. And even if Trump gets all his things that he wants to in place, it's going to take a while for things to change. And I just don't see any major changes happening this year. But I've been wrong before, so we shall see. Um, so a lot of people say, well, what about the presidential election? What about Congress and all these different things? I just don't think they're going to be able to reduce the budget. I don't think they're going to be able to reduce the deficit. I don't think they're going to be able to reduce the debt nearly as much as we need and nearly in the amount of time that we need it. And now Trump is pushing Powell to reduce rates. Well, the bond market is saying, no, you don't need to reduce rates. I mean, I don't know that that's a good idea, because what if we reduce rates more and the bond market is continues this action? So I think we should just pause where we are and let things work themselves out. So that's what I had for you today. I wanted to give everybody a chance to ask any questions. So I know we've got folks I haven't had a chance to see in person for quite some time, and I really do miss you guys, and I'm so grateful that you do at least dial in to see me here, even though I can't see you. But one of these days, I'm going to figure out a way using TikTok to turn on your cameras and without your knowledge. Um, so any questions out there? Did I do that great? Let's see. David, you got a question? Paul, Steve, Ted, Gene, Bob, all you guys, Mary, anybody? All right. Well, I'm going to go with that. Many of you know how we work. We've got the three-headed monster here, right? So we've got our legal team, our tax team, our financial team, and a lot of times we work behind the scenes to your benefit. A lot of times we'll be talking about you behind the scenes, and our tax team and our financial team will be coordinating and right around October, November, December to see what type of tax benefits that we can create. Sometimes that's tax loss harvesting. Sometimes it's a Roth conversion. Sometimes it's an IRA contribution. Sometimes it's a required minimum distribution that we're taking a little bit early to take advantage of some tax benefits. Sometimes we're doing a donor advised fund. Sometimes we're doing charitable bundling. So I can't tell you all of the benefits that we get out of coordinating our financial and tax team at the end of the year, because after January 1st and after December 31st, it's too late. Can't do anything. And most people only talk to their CPA, when they're reporting their taxes. So we take a lot of pride in that. And anyway, if I don't have any other questions, I will see. This was our crowd from yesterday. Not exactly the picture from yesterday, but the same folks. These are all about the same people. And we did miss you, and hopefully we'll see you in person soon. And without that, I don't see any questions popping up, so I will bid you adieu. Thank you very much.